Hello, viewers. Welcome back to another edition of Global Stock Views. We have some exciting topics and high dividend paying companies to cover for today's discussion. Let's jump in. Let's check out the April 2025 market conditions. It was a high volatile month of the year, primarily because of tariffs and trade war policies. The current government has been playing a very complicated trade war with other countries. We don't know the outcome of it, but some of the trade war or trade policies have been enforced by this government has some ripple effect, and that is actually causing some kind of churn in the stock market too. So it is very high volatile condition in the market right now. It's getting better. End of the month, it is getting better. Trade wars have been a little bit siloed for now until the negotiation is done. There's a 90 days pause. So hopefully, this current government will find some common grounds with the other countries. When you look at this particular month, S&P 500 and the Dow Jones was down around 12 percentage currently, but since peak, it is down around 20 percentage. So it went down 20 percentage, recovered on past few weeks. It has recovered 10 percentage. Now it's around 12 percentage down. The end of the month was a good sign. Some of this tariff war trade wars kind of siloed. That actually caused the market to recover some of the losses. So it has recovered around 10 percentage. Recovery is done, but still another 10 percentage to go. But in general, now if you look at this sector wise, bunch of sectors have been performing well, and especially this month, the top performing sectors are financials. It is kind of up 2%, around 2%. Industrial is up around 1.7 to 8%. Material is up around 1.7%. These are some of the top performing sectors for this month. The lowest performing one is the consumer staples. It has not gone up more than a half a point. So that is how the current month is. For past, if you compare the data with the past year performance, for past 1 year performance, financials are in a strong position. Around 20% growth is there. We are seeing this trend across countries. We have seen a bunch of these emerging countries are also having a good performance shown in the financial sector. Banks are doing very well, regional as well as the global banks are doing very well across all countries, not just US. Utilities are doing better in US, around 23% recovery. Communication services are doing well. Some of them are like AT&T, Verizon. These are playing very well. They have gone up significantly because of the current market conditions. Underperforming sector past 1 year has been always technology has been a big hit. It is around 0.25 growth. Material is 5% down. The technology, there's a good chance that it will recover. Definitely, it will recover. Majority of them have invested their money in the technology sector. It is underperforming right now for past 1 year, but I'm hoping things will get better very soon once this tariff and trade wars are done. Then we have some good synergy in the market. Hopefully, the technology should come back to its normal performing trend. In terms of volume wise, currently financial volume has been significantly high, around 35 million something on an average. We are seeing all financial sectors, all financial stocks have been having a heavy volume trading. And then the lowest one is the communication service, around 3.54 million stocks have been traded on an average. So this is kind of a sector performance, overall sector performance, month-wise, year-wise. We will dive deeper into the S&P and other favorite stocks for this particular month's preview. Let's start with the Spider 500, which is S&P 500 index fund. I always start with this index fund, which tells you how the market condition is. If you've seen my previous video, we have kind of high level predicted how the market condition is going to be for April month. On 13th of March, 11th, 13th of March, it has hit the lowest, which was around 550, 551. Then the buyers came back, bought more shares, thinking that that's the bottom. Then the positive momentum went up. It hits 575. It couldn't sustain that 575 kind of downwards pressure at 575. The price went down for Spider. It hit another low, kind of 548, which is lower low. Then again, buyers came back, bought a few more shares. Then there was a gap up. I think around early April, that's when all the tariff war started. That's when we see a significant drop in the price movement that went all the way up to 490, 492. That was the lowest it went, S&P 500. And if you look at it, the last time it went to this low was around April month 2024. So that's when it hit that 494 mark. And we kind of predicted the same thing. It's going to hit somewhere the lowest of low, which could match some of those previous lows. It matched. Then it came back. Buyers came back again saying, okay, that could be the bottom. They again did a positive momentum, started buying shares. It went up to 540, couldn't resist, went down to 511. Now, once the tariff kind of put on hold for 90 days, market just significantly came back. At least 12 percentage of a recovery happened at the end of the month. So that's the trend which kind of we highlighted, predicted last month. The price movement was exactly the same. If you have seen it, my previous video, go back and watch out that previous video too. You could see that the price movement was pretty much kind of closely predicted, and the trend, especially the trend, was predicted, and it was pretty much matching with the way how April month went. So that's kind of a high level on the spider. Spider is recovering right now. I think it has recovered 12 percentage, and I believe it's going to sustain here, slowly, gradually growing up. I'm kind of positive. Like next 90 days, it's going to just keep the kind of a neutral sentiment going rather than being over aggressive and recovering the whole peak percentage, recovering back to 600 something. That's not going to happen until we see a good conclusion or kind of end results of this tariff war, which again, this 90 days is going to be crucial. For now, next 90 days, if you look at the trend for next 90 days, this is how it's going to be. Again, a very sustained movement, very slow paced movement. You won't see this much spike happening, but my prediction is that it's going to gradually build up to that 90 days momentum. Once we hit that 90 days and the results come out saying whether the trade war is going to continue versus we have some conclusions, some results, outcome, a positive outcome, that could basically turn the trend to a more positive sentiment, and it should recover the remaining portion of the S&P 500. If the outcome after 90 days is not favorable, then we could see again market doing the same trend what we have seen in the April month. It should spike up, spike down, probably find new lower lows, and maybe this time, if the outcome is not positive enough, then we might cross the a year performance down. I think it was around 491. It should find a new lower lows. So that's kind of the prediction I see. But for now, the momentum is kind of in a sustained mode. So we will just keep this sideways churn going. That's what my prediction is. And again, some of the things we have to monitor how the market is doing too. A lot of small positive news will come. It's again earnings month. You will find some good positive news across all sectors, all companies. So you should see some gradual recovery of S&P 500 or in general any index funds. You should see that momentum slowly picking up and wait till the 90 days comes in. So it's going to be a slower pace for now. So that's kind of the high level prediction on the S&P 500. Again, keep a close watch on what's going on in the market, news, trade war, policies, everything that would significantly impact how the stock market is going to react. Let's look at our this month's stock view. I picked up three stocks. One is the Target, second one is Pfizer, and third one is Altria Group. Why did I pick up these stocks? These are dividend paying stocks, a good decent sized dividend paying stocks. That's what I'm primarily focused on for whole this year. If you have seen my previous videos, I've projected some of my numbers, regular monthly dividend numbers. So please take a look at it. It was part of my February and March months, the aggregate numbers I've showcased there. So take a look at it if you're interested in. So this month I picked up these stocks primarily because they are a good dividend paying company, and I've been investing in dividend paying companies. Some of them were outperformed in the sense they've been overvalued too because their PE ratios were very high. When the PE ratio is very high, there's a significant volatility in those stock price. The moment I was looking for something which is stable, decent sized companies, not underperforming but undervalued, as well as and then consistently paying you dividend and a dividend growth too. So those are my key criteria. I looked at it for this month. I picked up these three stocks. They've been paying dividend for a very long time. Some of these companies have been paying for more than 10, 15 years. And their dividend growth is also good, around 1 to 2% on a regular basis. So their dividend, they're appreciating whatever appreciation they are getting in terms of price movement. They're also sharing that appreciation with the investors too. So their dividends are also growing. not significantly, but gradually it is growing 1 to 2%. There's a growth every quarter, every year. At the same time, the volatility is also kind of minimum, I would say. So if you have invested 10K, assume that you have put that money into some of the overperforming, overvalued companies. Due to volatility, there is a significant risk. How do you reduce the risk? You need to find the stocks which are a decent sized company, good revenue model, good earnings, and a very less fluctuation in their price movement. That actually gives you a better risk to benefits ratio. So those are my three criteria for this discussion. So I picked up these three stocks. Let's go deeper into these stocks. Let's start with the company Target. Target is a retail company. They are a general merchandise store, primarily dealing with household goods, electronics, food, toys, you name it. Everything is available in one stop place. They've been performing kind of moderate past year and a half. They had a significant downfall in the November month. Their revenue went down around 19 to 20 percentage down. That actually had a significant stock price down too. So it was previously reported as 158. After the earnings, it went down to 121. So which was a significant drop. It tried to catch up that or kind of try to recover that downfall. It did move around. It did recover around 16 percentage, but the stock price had a significant downfall, as well as the projection was also pretty low. The forecast was also pretty low last year, so they have been underperforming. And looking at the stock here, they had a significant sideways turn since 2023, 2024 May till kind of end of the year till November. They've been on the sideways movement. The momentum was not positive enough, so they were kind of sustaining the whole effort. That's what you could see in the price movement. It was always on the sideways turn. And if you have seen my previous video, I usually use this box theory method, and this generally tells me when it hits the support level, when it hits the resistance level, and then anything crosses the resistance level, that's when I support or resistance level. That's when I consider whether to enter versus exit. So when in the normal time frame, we have seen that significant change based on the performance numbers. The earnings were significantly down. The forecast was down, so it actually gapped up. It has a significant gap down. You're looking at somewhere around 20 to 30 percentage down, and it tried to recover 16 percentage since November till end of Jan. It has recovered 16 percentage, but the momentum was again down, so it again went down. The price still dropped off. The buyers were trying to give some kind of positive momentum, but it couldn't take the downward pressure, so the price significantly went down. It went down around 26 percentage again. So this was, if you have seen the trend, this was the lowest low, picked up, kind of pulled back, and then a new lower low here. Then it kind of sustained since kind of March timeframe. Again, some of those things were new government, new policies. We were not sure what's going to happen for some of these retail companies too, because the new government significant policies were with the tariffs and trade wars. Previously, we have seen in the previous term too. Some of these retail companies were playing safe. So we had a sideways turn for March month, and then significant drop in the April month when the tariff policies or tariff announcements happened. That's when they expected some kind of downfall, which kind of hit the lowest low, which was around 88. So this is kind of underperforming right now, undervalued to price movement. So I'm expecting the sideways turn to continue, because some of these products they are selling are coming from multiple countries. The tariff could hit those their margins too. So I'm expecting some level of sideways turn, gradual growth. But is this the bottom? I am not sure, because again, this comes down to this 90 days policy. They have kind of paused right now all the tariff uh, announcements. They're waiting for the negotiations to complete with the other countries. Maybe some of the favorable outcomes could lead this stock to recover. But again, if you look at it, why did I pick up the stock? It is kind of in a neutral state, but looking at their dividend is around 4.58 percentage, and their PE ratio is around 10. not super high, but it is not super low. It is kind of in the moderate range. That's their average kind of PE ratio. 10 between 10 to 11 is their range, and which is a decent size company paying you a good dividend, kind of undervalued looking at the PE ratio, and their EPS is around 8.89. So these are some of the metrics which I picked it up. Again, look deeper into this PE ratio and EPS. Some of these dividend paying stocks have kind of a lower level PE ratios. You know, anywhere from 10 to 25 percentage is a decent PE ratio to look at it, where you don't have very high volatility in this company price movement. So you could see that the earnings were down significantly November month. I'm expecting that should recover. Again, some of the forecast is very low. I'm expecting some kind of sideways turn for the price movement. It's going to be sideways turn for next 90 days. After 90 days, whatever be the tariffs outcome, we will see a kind of change in the trend in the price momentum for this particular company. But looking at the dividend, it is paying you 4.58, and looking at the dividend significantly from since 2008, you see that dividend per share has gone up significantly. They're paying around 4.46 right now. Dividend yield is anywhere between 2 to 3 percentage, in an average 2 percentage, which I see, which is a decent growth every year. Um, Based on these metrics, I consider this as a good buy. I did invest in Target, and primarily because of dividend right now. So I'm waiting for their dividend to come. It's basically the ex-dividend date is on May 14th, so it is not there yet. If you're like this particular company, and if you have done some more analysis and you feel confident in investing in it, May 14th is going to be the ex-dividend date, which means that if you buy now, retain till May 14th, good chance that you get a dividend when they pay the dividend to the investors. The next stock is about Pfizer. Pfizer is another good dividend-paying company. Their primary business is on the pharmaceutical side. They've acquired so many good companies. That's their strategy. Strategy is to find the good growing companies with a good product, good pattern. They basically acquire those companies and put their brand name on top of it and start selling. And then they have their own core products. So if you are closely follow the pharmaceutical company, big giants are always going to be living longer than the smaller ones. There are good companies like Seattle Genetics is one, got recently acquired by Pfizer. There are so many companies like this, these aspiring, high-growing companies who have been acquired by some of these big giants. And one of the giant is Pfizer. Pfizer has been very profitable. They have their own products, medical products in line. Additionally, they do acquire some of these small companies who have good products and distribute those medicines through Pfizer's label. So that's their primary strategy here. And looking at this particular company, again, this is an underperforming, undervalued company. Their price per earnings ratio is around 17 percentage, which is a very decent one. Some of the big mega companies also fall under this range. Anywhere from 15 to 25 is a very decent size, a good revenue making, money making company. But the stock price doesn't show exactly how they've been performing. They've been performing kind of average, I would say, but they still have a good lineup of products, medicines who've been distributed across the world very successfully. So it's a successful business. Again, some of those fluctuations are very low compared to other companies, and this one is another example where your volatility is very minimal, and good dividend paying company, less risky. Uh, they do have some kind of potential risk in the future when the current government, US government, start investigating the price growth in some of these pharmaceutical companies. These companies were spiking up the prices, and there's so many reasons behind that. When the government starts investigating this price growth, and to benefit the customers, they could put some policies which could impact the pharmaceutical companies down the line. So we don't know what the policies are going to be, but for now, these companies are performing kind of in a more moderate range. So this is a undervalued company which has an EPS ratio of 17.34, good size. But the biggest plus point here is the dividend yield. Dividend yield is around 7 percentage. So if you have invested and kept the money, uh, and let it multiply. They pay you a really good dividend, 7% dividend. So, which is a good dividend compared to other companies. And the downside risk is a bit low too. This is a decent sized company, and if you look at some of the revenues, last year October timeframe, they had some negative surprises. Around 107 million drop in the initial estimation, but the revenue is around 13.23 in an average 12 between 11 to 13 is their revenue model, and some of the analyst estimations were also pretty close to it. And they've been consistently paying dividend for a very long time. So if you look at their dividend model too, financials wise, let's go look at the dividend model. So the dividend, they've been consistently paying since 2008. There was a significant growth, slowly growth in the dividend per share, which is now 1.69, and the dividend yield is somewhere around 3% on an annual basis. So there are good years, there are kind of not good years. You could see in an average you are dealing with somewhere around 3 to 4%. It's a very decent sized growth in terms of dividend yield. So currently the dividend yield is around 7%. Again, some of these high paying dividend companies, sometimes they have a high volatility. And if you see the stock price since the last December 2022 December, they had a significant drop, which is around 48% down. But they've been paying dividend consistently. They didn't have why they've been underperforming. Again, some of those product lines would have had some impact. But they do have some good companies acquired recently. They are making some good money. And if you look at the price trend in general, kind of a shoulder pattern. We can see a similar shoulder pattern there. And overall, they've been in kind of a sideways movement past kind of year and a half right now, since Jan 2024 onwards. You could see that the price is somewhere between 20 to 20 to 30 mark. That's the range I see. So they have been fluctuating within that price range. And off late, in the April month, when all the tariff war started, tariff and trade policies have been implemented that had a negative impact on this company too. So you could see that the price movement actually went down to somewhere around 21. This is a good buy. Again, some of these investors who've been closely watching these pharmaceutical companies, big giants. This is one of the big giant company. They thought that this is the bottom. So they kind of bought in this price range. So I also kind of invested around $22, 22.50 is the range which I bought few shares, a few buckets of shares. Again, so that's as per my analysis. I was looking for a more dividend paying company. I'm not looking for which has a good significant price appreciation. But these companies are going to uh, grow slowly in terms of stock price, but they pay you a decent size dividend on a regular basis. So 7% is a pretty decent size. From the volume standpoint, I think if you look at my core strategies are pretty much price, volume, and relative strength index. Strength index is kind of in the low, coming up right now. It is catching up right now. Volume is pretty decent, I would say. There have been fluctuations here. Um, Again, some of the fluctuations, some of the accumulations are happening right now. You could see more greens off late than sells. So you could see a consistent 5 days. There have been only accumulation, distribution was pretty low. In an average, you're looking at 40 to 50 million shares getting traded per day. So that's the average, and I think consistently hitting. And you could see of late there are more accumulations than distribution. So which means that the investors are thinking that it has hit the bottom and it is picking up again. Some of this tariff trade wars could impact because Pfizer also has good significant inflow of or import of drugs from outside too. So watch out for those policies closely, which could have an impact on the price. From the growth standpoint, I know there is the 9 days simple moving average just crossed the 20 days moving average. So that's a sign of saying that the price movement is actually in the upward direction. It's trending up. Well, decent size volume, average volume. There was not big surprises there. So I'm expecting a consistent, steady flow of price movement, less volatility. That's what you want when you are looking for a good dividend-based companies. Overall, it's a decent sized company, good revenue around every quarter, around 13 to 14 billion. Sorry, anywhere from 11 to 13 billion is their range. If they stick to that range, probably you might get a decent size price appreciation too. I think the other point to discuss is that when will this price will recover? Again, the growth is there. It depends on when you enter into this particular stock, right? If you enter it in a right place, right timing, then the price appreciation will be good. And in this particular instance, I believe this was considered as a down good buy point for us. So that's why I entered into this trade. I bought something around $22. So it has appreciated well for at least 20%, close to 20, yes, close to 10% appreciation is there. I'm expecting a little bit more growth will be there, but they pay you a good dividend. So dividend actually takes care of some of the risk part of it. So it's a good, decent sized company. And from the indicator standpoint, it's in a buy mode right now. Here's another company, exciting company called Altria Group. The ticker symbol is MO. M for money, O for Orlando. Altria Group, MO. Altria goes back more than 100 years history. Some of these companies have started in 1800s, and they've been primarily on manufacturing tobacco, smokeless products. Smokeless products are nothing but the alternate for the cigarettes. You don't need to burn to get that feel of it. These are kind of tobacco products where people tend to keep it in their mouth and still they get that nicotine and other chemicals with it. So that's an alternate for smoking cigarettes or generally cigarette product. So they are kind of a pioneer in that product line. Their primary focus is manufacturing tobacco, cigarettes, smokeless products, and then recently, if you have seen some of the e-vape vapor products too, Julu was initially they had some investment there, and some for some reason they actually exchanged all their stake from that particular company. Now they recently bought a new company called Enjoy. That's another company which is getting kind of new product line in the e-vapor related products. So they are kind of exploring the traditional cigarette manufacturing and also getting into the new innovations like the e-vapor related products. So their product line has been pretty solid for close to or more than 100 years now. They've been selling the cigarette products. Now they're exploring on some new technologies. So hopefully they will build the revenue around that new product line too. From that standpoint, this is a very good product. Again, some of my criteria for this particular month discussion is that lower P value, undervalued company, paying you a good dividend consistently for more than 50, 60 years. Some of these were paying for more than 50 years, and has a steady growth in the dividend as well as a steady growth in the yield. So those are some of the criteria which I picked it up. Looking at some of the financials here, past 1 year, it has significantly like close to 35% growth from the estimate standpoint, from the earnings standpoint, they've been consistently hitting their estimates. So it's a very well run company with a good solid product line and good revenue model built in. And the competitions are there, but these guys are pioneer in this product, so they've been doing pretty good. But my key criteria are basically this one: dividend yield is around 7%, 6.84 right now, but it is close to 7%. So which is a pretty good dividend yield company. So some of these cigarette manufacturing companies across the world, they've been performing steadily well. You go to Asia side, you go to Europe side, the big long-term companies, solid revenue model companies are these cigarette manufacturing companies. So this is no different than other companies. So this company has been performing very well for more than 100 years now. They did the 100-year celebration 2002. So now they're around 125, 3 years now. So they've been in the market for a very long time, industry for a very long time. From the dividend standpoint, they are. I have history from 2008. It has a steady growth. You could see that dividend per share has steadily grown to currently 2024. It's around $4. Dividend yield percentage is also kind of fluctuating. There are good years, there are bad years, but in an average, if you look at it, around 5%, 5 to 6% is a decent prediction. You can look at it. So 6% of your investment annually is a very good return compared to other investments, other types of investments. So from the dividend standpoint, it is a very good company. Now, from the performance standpoint, let's look at the stock price performance. Since 2024 Feb onwards, there's a significant, growth. It has the trend is in the positive direction. You could see, and it has formed a good cup handle pattern on a consistent basis. So this actually puts us in a mode that this is more predictable company price movement or stock price movement. You could see that there's a predictable pattern here, the cup handle pattern. So you should see a price drop, a pullback, and then forming that cup, and then going back again for finding the new higher highs, crossing the resistance and forming the new higher values for the stock price. That's consistently going to happen. So you should see another cup and handle formation. So find opportunities like that when it hits that bottom of the cup. That's an opportunity for you to invest in it. From the trend standpoint, since February 2024 onwards, it has grown 38% growth. That's pretty much aligns with what the financial data shows here. And at the same time, the depth of some of these cup and handle is around 11%. So it went down 1%, went up 11%. Then similarly, another 11% here, 11 to 12% here, and then went up 12%. So if you are looking for investing in this company, find the pullbacks, and the pullbacks are going to be somewhere around 10 to 11 percentage. That's when it tends to move back, get that momentum back again. So also look at when you're investing, when you're looking at some of these charts, one primary thing to look at it is that how far the pullbacks are. And when I look at some of these trends and put the numbers closely, the trend lines, it clearly tells you what is their lower limit, or the bottom, which is basically in this case is around between 10 to 11 percentage. So when it reaches that pullback to 10 to 11 percentage, that's when you should keep your cash ready to invest back in. There's a good chance that it has seen the enough bottom, then it will start the momentum start building up. So at the same time, also look for the RSI. RSI is, it has gone peak and now it is coming down. We should see another kind of newer high slightly when it hits that 60, 70 mark in the RSI, and that's when we should see the pullback again, similar to the pullback which we are seeing here. Consistently, you can see there's a overvalued and then pullback, comes into undervalued, then again starts building the momentum. So similar patterns we should see. So watch out when it hits between 40 to 30 RSI mark. So from the fundamental standpoint, looking at some of the volume standpoint, in an average, the volume is around 8 to 9 million shares getting traded on a regular basis. And off late, you could see some distributions happen. Again, this goes back to some of the recent tariffs and trade war policies implemented. That's when some of those price momentum gave up, since they went down and people started selling. Now slowly you could see the accumulation is also building up. So watch out for those kind of opportunities when the negative news comes in and the global market is actually getting impacted. Those are opportunities for you to wait on the sideline and invest back when it is coming back again. So from the fundamental standpoint, it's a pretty good company. Slow growth, but it's a steady growth. Good dividend paying company. EPS is in a uh, underperforming EPS. Underperforming EPS, as well as I would say from the price per earning ratio is also kind of underperforming, but they have been steadily growing. So it's a really good company. I personally don't invest in anything related to tobacco or alcohol based companies. That's my style of investment. But I know some of my friends and viewers, they tend to invest in these companies. So feel free to invest in. That's why I brought this company for our today's discussion. From the growth standpoint, it is growing in a right direction with a good dividend. Take advantage of it. Thanks for watching my video. Stay tuned for more updates, more interesting topics to cover in the future. Until then, stay invested. Thank you. Bye.